So how the two are different? Gross investment is basically the total addition to the stock of capital goods during a year. Okay. And net investment, why we need to differentiate is because whatever we have the fixed assets, like the machinery, like the building, the equipment, they go down in value with usage over a period of time. So to that extent, your gross investment goes down and we need to take this into account. Okay, so that is why we distinguish between gross and net investment, and that difference arises because of the depreciation or consumption of fixed capital. Investment, as we know, has two components, the fixed and the inventory part. So the fixed part goes down in value due to its usage. Okay, and the difference between gross and net arises because of this consumption of fixed capital or depreciation. Now, what is depreciation or consumption of fixed capital? It is the fall in the value of fixed assets due to normal wear and tear, passage of time, and this third line is very important, expected obsolescence. That every machinery with usage is expected to become obsolete. Why? Because over a period of time, the technique to produce goods and services changes. Like even if we take any vehicle also, we had diesel vehicle, petrol vehicle, EV. So the technique also changes to produce these cars. Similarly, there is a change in demand. Similarly, there is a change in government policy. Because of all these three factors, every technology becomes obsolete over a period of time, and we are talking about expected, that this is something you expect, that a certain technology will go down in value over a period of time. So the gross and net difference arises because of this depreciation. Gross investment and net investment. The difference between the two is depreciation or consumption of fixed capital. From the gross investment, if we subtract depreciation, the value of investment which has gone down, we get the actual value of investment, which is net investment. And if in net investment we add depreciation or consumption of fixed capital, we get gross investment. Now this is very important difference to know, because this will be very useful when we do the numericals. Gross जो है is the one investment which includes depreciation, and net investment is without depreciation, the actual increase in the addition to the stock of capital goods during a year. Need to know the definition. Now when we talk of consumption of fixed capital, there is another concept also related to it, but before we go to that concept, we need to know how to calculate depreciation, because over the years there has been very simple numericals based on how to calculate depreciation, especially in the value added method. So there are two methods of calculating depreciation: straight line method and written down method. In the straight line method, what you have to do is you have to take the cost of fixed asset minus scrap value divided by the useful life in number of years. So supposing you have an asset, say the value of that asset is 1 lakh, okay, and supposing there is no scrap value, so the scrap value comes out to be 0, and the machinery is expected to last 10 years. Okay, so that means every year there is a depreciation of how much? 10,000. Okay, so the value of machinery every year is going down by 10,000. So that means a firm in a way has to keep aside certain funds so that after 10 years it should be in a position to replace that machinery. So this is your written down method: cost of fixed assets minus scrap value upon number of years the machinery is expected to last. The other method is generally the written down method. Here what we do is that we take the depreciation, supposing in the first year we take the cost of fixed asset into depreciation rate. Okay, so here the depreciation rate is say fixed at 10%, and you take the cost of fixed asset. Okay, now supposing the cost of the fixed asset is again 1 lakh. Okay, so the 10% depreciation of this 1 lakh asset will be This will come out to be again 10,000. So first year the machinery is expected to go down in value by 10,000. Okay. So the next year when you calculate the depreciation, you take the value of asset not as 1 lakh but as 90,000, because the value has gone down by the depreciation. So you take the cost of fixed asset, that is 1 lakh, minus depreciation of year 1, which is 10,000, you get 90,000, and then you multiply that with the depreciation rate. Okay. So in written down method, the depreciation rate remains the same, and so the depreciation amount keeps reducing year after year. While in straight line method, you have a direct same amount of depreciation every year. So two simple methods to calculate depreciation. Now we come to capital loss. Capital loss sounds similar to depreciation but is little different from depreciation. Depreciation is something you are making provision for, you are taking that into account while calculating net investment. But capital loss is when you suddenly lose the value of the fixed assets, maybe because of some natural calamities, maybe because of some earthquake or some forest fire or some theft, accident, and unforeseen obsolescence. Unforeseen obsolescence is there is a sudden shift in technology. Technology suddenly changes. You were expecting the same technology to last, say, for next 5 years, but suddenly something new comes up and that product is no longer required. Here I have given the example of pager. Pager, when the mobile phone came, then before mobile phone, at the same time, when mobile phone came, there were pager also, because mobile phone was only for making calls, not for sending SMS, etc. But pagers was meant for making SMS, for sending SMS. Now this product was expected to last, but what happened was that the same feature came in the mobile phone. Now suddenly this product pager, which was expected to be a cheaper one to send messages, which could be used by anyone, was replaced by a mobile phone, because all those services were available with the mobile phone. So very you can say very fast, unexpectedly, the product became obsolete. The product was no longer and so the technology was no longer demanded in the economy, because the same thing was available with a mobile phone. Okay, so capital loss is different from depreciation or consumption of fixed capital, because this is something you are expecting. This happens suddenly because of calamities, unforeseen obsolescence, and thefts and accidents. You make provision for depreciation, but it is not like this. Capital loss, you do not make such provisions. So when there is a capital loss, it affects the production process. Supposing because of earthquake or the forest fire in an area, the whole area gets destroyed. So that is a capital loss that will have an effect on the production. Agar factories and other things get burned, it will lead to hampering the production process. While in depreciation, since you have kept the provision, the production will continue to happen. Okay, so keywords here is to know the difference between expected obsolescence and unexpected or unforeseen obsolescence. Unforeseen obsolescence is capital loss, while expected obsolescence is depreciation. So there are a few numericals that will take up later on. Now we come to a very important concept, and that is the difference between final and intermediate goods. And this is very important because in calculation of national income, we need to know what is to be included and what is not to be included.